The views expressed in this video are those of the panelists and do not necessarily reflect the views of U.S. Money Reserve.
Welcome to America's Gold Authority podcast. My name is Mike Barnes. I am your host, and tariffs continue to be in the headlines. That is our topic for today. We have a couple of great guests to give us some great insights about this. First of all, it's Philip Diehl, 35th Director of the United States Mint and the President of U.S. Money Reserve. Philip, I'm so glad you're here.
It's always great to be with you, Mike. Thank you.
And we also have the great insights of Brad Chastain, the Director of Education for U.S. Money Reserve. Welcome, Brad.
Thank you so much, Mike. Happy to be here.
Tariffs, again, are in the headlines, and a lot of people, analysts, are saying that the June report says no signs of higher inflation because of the tariffs. Other people say there are signs. Philip Diehl, tell us, what is the deal there?
Yeah, I think it's fair to say that we're seeing the very first signs that tariffs are may be affecting inflation rates. The thing to bear in mind here is that it's a very small effect at this point, and 1 month of data is not a trend. The data moves back and forth, up and down, and so we'd have to see more months of data indicating a trend. I think the expectation is that over the next couple months, we're likely to get a confirmation of this initial indication that inflation rates are ticking up. And by September, I think we'll have a better fix on it. That'll give us the July and August data. But I think the initial signs are that we're seeing an uptick in inflation.
Brad, are you seeing similar signs?
For sure. Yeah, this last month in the June report, we definitely saw a tick up there, and it was expected that we would see that. And, this is, like Philip said, it is 1 month. Over the last few years, inflation has been ticking down very slowly over the last 2 years after it came down pretty sharply after the COVID highs. But over the last couple of years, it's been ticking down very, very, very slowly. And you do see that it never really goes in a complete straight line. You have some up months and some down months and things like that. And to Philip's point, the overall trend is what is important. So it's important to watch. And what a lot of people may not realize as well is if we don't see it sort of stabilize, and if it comes down too fast, that actually can be a very worrying sign. Because what you would typically expect to see is when you have strong economies and strong growth, inflation is the other side of that coin. You tend to get higher inflation in those environments. That's why the Federal Reserve comes in and enacts in the ways they do with interest rates and to try to slow down the economy to handle inflation, in fact, in those strong economies. So if we continue to see the trend go lower, if this is just an aberration, just 1 month tick higher, that's actually kind of a telling sign about the state of the global economy, because that highlights that demand is actually potentially falling off faster than any effects of tariffs on prices. And so that would be a worrying signal or red flag at least, for the global economy.
Mike, I think there's another perspective to bring to bear here in this conversation, and that is the Fed has never gotten down to or really close to its target of 2% inflation. And so anything that suggests that we're reversing course, then that's a concern, especially for the Federal Reserve. And this most recent report indicated that inflation rates have ticked up from 2.7% to 2.9%. And so I think that is a worrying sign that we're headed the wrong direction. We're not making the progress, the slow progress that Brad was describing. And if that continues, then I think we're going to see the Federal Reserve very reluctant to cut interest rates, as we've all been hoping they'll be able to do, at least by September.
It seems like there are so many things we need to watch about inflation, and one thing that we're definitely seeing is President Trump issue some new threats to levy some big increases in tariffs against countries like Mexico, Canada, Brazil, European countries as well. Are these threats, do you think they're credible, or do you think that it's something, Philip, that is just say so, that they're just trying to come up with something to try and spur things on?
Yeah, I think this is a basic question. Is the president serious in making these threats, or is this a negotiation tactic? And we've seen evidence on both sides since Liberation Day that he's serious, or that this is a negotiation tactic. And of course, it's possible that it's both. The one thing to bear in mind, however, is that since January 1 of this year, when the effective tariff rate in the U.S. was 2.4%, today the effective tariff rate is closing in on 20%. So we have already seen a huge increase. That's a 7-8-fold increase in the effective tariff rate already in effect. And we have these other tariffs that are scheduled to go into effect August 1, and others that have just more recently been threatened. And those are very large increases. So if the president has to be believed, he's certainly credible in these threats, because he's already had a big impact on the effective tariff rate, and we could see more. And that's one of the reasons why the Federal Reserve really has to be careful here, is not only are they looking at the impact of the tariffs that are already gone into effect on the economy as they slowly are feathered into the economy, but also we have these other big threats that are on the table, and the Federal Reserve has all this uncertainty to deal with in making decisions about where to go with interest rates.
Yeah, and I would add, it's not even just tariffs from their perspective. This administration has been pretty clear. Treasury Secretary Scott Bessent has said that the goal isn't to really pay down the debt, it's to try to grow our way out of that, to reduce debt to GDP, grow GDP. And the way that is ultimately done is in an inflationary way. It's through increased spending and things that grow nominal GDP, which reduces the value of the debt, but the real GDP on an inflation-adjusted basis doesn't necessarily have to be higher. So that's something that if they know that is going to be the policy, to try to grow way out of debt and through potentially inflationary measures, they know that's in the cards at some point and have to be very careful about how they handle it prior to seeing that sort of growth.
Yes, and I think there's a question of timing here too that's really important to bear in mind. One is that the impact of the tariffs is basically immediate, in a matter of a few months, whereas the impact on growth is much longer to play out. Companies expand production, expand investment, hire, move facilities from overseas back to the U.S. over a much slower period of time. So we're likely to see the impact and the cost of inflation before we see any benefits from, or much in the way of benefits from, additional economic growth.
Brad, when we watch the headlines and different countries are announced that a tariff has been imposed or a tariff has been raised, increased, does it matter which country it is as far as how it affects the U.S. economy and inflation, or is it all uniform?
No, it's not all uniform. It's going to depend on what types of goods the tariffs are being imposed on. So, and that varies from country to country. So, discretionary goods where we could easily go without or have other alternatives out there, it's not going to have as significant of an impact, right? We can avoid paying those tariffs, go somewhere else to get those. If that country wants to sell to us, they're going to have to lower their prices. Japan has done that. That's a good example. In fact, Japan on auto manufacturers, last I saw, cut prices by like 25% or something like that. There's plenty of places we can get cars, not just Japan, right? So in order to be competitive, they've actually been the ones in that case eating the tariff costs on those particular goods. Other goods that are that we do not have substitutes for, and that we have to go to those places to get those. That's going to be much more felt at home, since the foreign exporters are going to have more pricing power and be able to pass or not have to adjust to offset for the tariffs, and demand on our side may not fall off if we actually need them. So it very much depends on the goods, which largely align to different countries.
Mike, there's another way that the goods that are being tariffed has an impact. One is there are goods that immediately come to market once they are input or brought into the United States. For example, fruits and vegetables immediately go to the marketplace, and so increases in tariffs on those products show up very rapidly at the grocery aisle. Other goods, such as aluminum and copper and other metals, are inputs into manufacturing, for example, automobiles. And those take longer to filter through the production process and have an impact on prices.
Philip, we've mentioned some dates, August 1st, September the 1st. When do you think that we'll have a better idea about how tariffs are in fact affecting inflation?
Well, that's a $64,000 question, and the one that the Federal Reserve is wrestling with. But I think we'll, again, as we said earlier, I think by September, once the August data comes in, we'll have a better idea of how the earliest tariffs, dating back to early April and Liberation Day, what impact they're having on the economy. But other tariffs that have gone into effect since then, it's going to take longer before we have an idea of what their impact is and whether or not they have a one-time impact on the economy, or whether they're going to roll over and have secondary and tertiary impacts, for example, on labor costs. And so I think the Federal Reserve is sort of hanging out there for an extended period of time before they really have a good fix on what's happening with inflation, especially if the president moves forward with his threats to impose these additional large tariffs.
And even the Federal Reserve is having a hard time working through it, right? The different members of the board or the committee are all divided on whether or not it's going to be a one-time sort of price impact or if it is going to be a longer lasting thing. So nobody really knows, and even the Federal Reserve is still watching and debating what the outcome is going to be.
Yeah, that's exactly right. You see people on the committee, the Fed committee that makes these decisions, the FOMC. You see them beginning to separate and take different positions. One thing to bear in mind is that the Federal Reserve Chairman Jerome Powell's term ends in May, and a couple of these members who are voicing support for cutting interest rates are actually campaigning for his job. So there's no better way to campaign for a job than to advocate the position that the guy who's going to hire you takes. So I think we need to watch the words from members of the committee who are not running to replace Jerome Powell.
Brad, if we do see signs of higher inflation, how are retirees affected?
Yeah, inflation is always a concern. Even at lower rates of inflation, inflation is always a concern for retirees, because when you live in retirement, you live typically 25, 30 years. And even at low rates, that's a tremendous amount of purchasing power lost over several decades. So that's always should be at the top of the retirement planning sort of decisions. And it's becoming increasingly important because, for one, we've had inflation, falling basically for the last 40 years. And so we don't have people right now working in the retirement planning space and in retirees that really were doing much during a different environment. Everything's built around that sort of falling inflation that we've seen. And when you retire and you no longer have income that is presumably adjusted for inflation as you get annual raises and things like that over time, you have to be very careful that nest egg is going to be able to maintain its purchasing power for the next 20, 30 years. Social Security, which makes up a portion of most people's retirement income, typically about a third is what it's really designed to do, has an inflation adjustment in there. But even if you believe that the inflation adjustment is actually going to keep pace with actual rising costs that you experience, it's still not a majority of most people's income. And in just 8 years, Social Security is going to have to undergo some sort of changes. We don't know what yet, but the Social Security Administration themselves says that the trust fund will be depleted by about the year 2033. And at that point, the money coming in from Social Security taxes from workers will only cover about 78 cents for every dollar of promised benefit. So you're talking right now projected a 22% cut in Social Security benefits starting in 8 years, if there are no changes whatsoever. I'm sure we will see some change. It's going to be more and more headlines in the coming 8 years that we'll see in political posturing in Washington. We don't know how that's going to play out, but that's not in your control as a retiree. And so you have to take ownership and plan and prepare and own things like gold that are well known to preserve purchasing power over extended periods of time.
Philip, that's the thing to remember, is that it affects all of us.
No, that's right. And but especially as people approach retirement, it affects us much more significantly. Number one is many investors become more conservative as they approach retirement. And that typically means they move out of stocks and move into bonds. And the greatest enemy of bonds is inflation. It is corrosive to fixed income individuals who are dependent upon their income from bonds, increasingly important on it as they reach retirement and go into retirement. And what we're seeing now, exactly what Brad is talking about, is we've had a sea change in how the economy operates, because all of a sudden, for the first time in 40 years or so, retirees have to really think about how a higher inflation rate environment is going to affect them, whether their income is going to last for 20 years and they run out of money, or whether it lasts for 40 years and they have enough to live a comfortable life. And in that context, as Brad was mentioning, it's crucial to look for another asset that will hedge you against that threat of inflation as returns on bonds deteriorates. And gold is today that key preserver of wealth, the protection of wealth, and should be a part of your portfolio.
A nice safe haven for everyone to think about. So much to watch for. Philip Diehl and Brad Chastain, thank you both for giving us some insights of what to watch for as inflation continues to change. Philip, thank you so much.
Thank you, Mike.
And Brad, thanks for being here.
Thank you, Mike.
That is all the time we have for today's episode. On behalf of all of us here in the U.S. Money Reserve Studios, thank you so much for tuning in. Hey, if you have any questions at all or want to learn more about today's episode, you can call the number in our episode description and speak with one of the friendly account executives. They're going to be very happy to answer any questions you might have about precious metals and the strategic role they can play in achieving a secure and comfortable financial future. Again, I'm Mike Barnes. We're going to see you next time on America's Gold Authority podcast.
The markets for coins are unregulated. Prices can rise or fall and carry some risks. The company is not affiliated with the U.S. government or the U.S. Mint. Past performance of the coin or the market cannot predict future performance. All calls recorded for quality assurance. Offer void where prohibited.